guys, I'm on here with Marina and Frank with Avison Mortgage. They're my awesome and favorite lenders. And we wanted to talk about what's going on in the lending world these days with higher interest rates going down, up. What's going on?
Hey guys, nice to meet you.
So right now there's a lot going on in the financing mortgage market, right? Obviously, everybody's talking about the interest rates. They're up and down every day. Right now, they're trending downwards. The expectation is that the Fed is going to cut rates this month, which in turn should bring our rates down a little bit. And then hopefully just before the elections, we'll see another, rate reduction, which is going to bring refinances back into the market. A lot of people are at, 7 to 8%. So those people will be able to refinance, maybe even lower. Also, there's a lot of talk about seller concessions. So this all plays into interest rate, right? Because you can get the seller to buy down your interest rate temporarily. So it's called a 2-1 buy down. Maybe you've heard of that. It used to be very prominent in the previous days when interest rates were at where they are right now. Before, when rates were low, it didn't really come into the picture very much, right?
What do the sellers do? Did they give you cash back at closing?
So what is really a 2-1 buy down, right? So 2-1 buy down is a seller can pay for the 2-1 buy down for the buyer, right? So how it works. So if you have a buyer who is putting an offer on this property and he qualifies, for example, for, right now, let's say conventional about 6.5, something like that, right? Mm-hmm. And if seller will give you seller concession, you can use that money towards either this temporary buy down or just the closing costs, cover some of the closing costs or all closing costs. So how 2-1 buy down works. So there are different options, right? So there's a 3-1 buy down, the 2-1 buy down, and so on, right? So let's just take example of a 2-1 buy down. Right. So the buyer qualifies when we look at the documentation and qualifying the client, we determine the buyer qualifies, for example, for 6.5 interest rate right now for this property. Right. And they use 2-1 buy down tool. So for first year, his interest rate will be 2% lower from what he qualifies for, which means instead of 6.5, you'll be paying interest rate payment based on 4.5.
How much does that cost at closing to get to that level for the first 2 years?
Well, it's really specific calculation. You have to
like a price range. How much would you need to pay extra closing costs? 5,000, 10,000?
So basically, it's going to be dollar for dollar, right?
Yeah.
So whatever the difference in the monthly payment is, because you're still paying the bank the same interest rate. That's 6.5. The difference in payment, all that money gets put into an escrow account and it comes out of there every month.
Okay.
So the beauty of that is that if a year from now the buyer goes to refinance their loan, that money doesn't go away. So whatever's left in that escrow account is going to get put towards their principal balance and reduce it.
Gotcha. Okay.
So it's a really great incentive if you're able to get it, from the seller to pay for it.
Let's see if we can calculate really quick, right? So, for example, the purchase price is $400,000, right? The borrower putting, let's say, 20% down, right? So the loan amount is $320,000, right? So if he qualifies for 6.5 interest rate right now, right?
2022 is the payment.
2022 is a payment. First year, he's going to be paying based on 4.5.
1621.
1621. Okay.
So it's a difference of $400 per month, right? Each month for that first year. And then that second year, it's going to be a difference of $200 per month.
Because second year, his rate going to go back to 5.5, right? So first year, 2% lower. Second year, 1% lower. Third year, it goes back to 6.5. So, and
the total amount that's going to need to come from the seller is going to be $7,201.
Okay, that's doable. Okay, so you just ask for seller concession, which I know the lenders usually cap it. So I don't know, in a $500,000 property, you could ask for up to 3% depending on your loan, right? So you could get $15,000 to help with that. Okay, that makes sense.
So in this particular example, it comes out to 1.8% of the purchase price.
Yeah, so
Right? So if your seller wants to give the buyer, say, 3%, you can use 1.8% to do the 2-1 buy down and use the remaining money to pay off closing costs, right? You're not going to cover all the closing costs, but at least you'll cut it, significantly.
Yeah, so let me add a little bit. I'm sorry, Elena, to interrupt you. So I just love to one buy down, especially in this market right now. So if $7,000 this borrower uses for a temporary buy down, right? That's how it's going to play out: 4.5, 5.5, 6.5. But the same money he can use for permanent buy down, which is he's buying the rate down permanently. Of course, it's not gonna be as low as 4.5. It would be closer to, I'll say, about 5.8 or something like that, right? Let's just make a guess, right? So, but the beauty of temporary buy down is that $7,000, if the borrower going to refinance this mortgage, let's say 6 months from now or a year from now, whatever is left of this $7,000 is going to be credited towards his balance, right? So that money never goes away, right? But if the borrower uses the $7,000 for permanent buy down, right? It's a one-time fee at the closing table. That money is out, right? If you're gonna refinance this mortgage 6 months, a year from now, that $7,000 is gone, right? So this is why temporary buy down is super popular right now, and because you can benefit from it right now. But if you refinance or sell the house, that money gonna go back to you if you didn't use that.
Okay. All right. Now I know that I've come in contact with buyers that are don't have, like my husband and I were self-employed, so we don't have a W-2. There are people that post-COVID have had, we don't really have that now, but they don't have proof of income. So you guys have these awesome loans where you can still get them approved, which is called, what is it, non-QM?
Non-qualified mortgage. Yeah, it's tailored specifically for this kind of situations, right? So when buyers, write off a lot of expenses on their tax returns, or whatever situation is that on the tax returns, it doesn't show enough to qualify the borrower. For those borrowers, we do have like several options.
So yeah, and basically we start with trying to fit them into a conventional loan, obviously, right? We do review the tax returns. If it doesn't work, then we just move it up in stages. So first stage would be a bank statement loan. What that means is we take the 12 or last 24 months worth of most recent bank statements, and we calculate the income based off the deposits that are coming into the account, right? There's an expense factor that we use. The generic expense factor would be 50%, but depending on the line of work that the buyer's in, like you, for example, being a realtor, your expense factor is not going to be 50%, right? It might be 20. So we would get a CPA letter to say that your expense factor is 20, and that's what we would use. So we could use 80% of your deposits for your income, right? Which most likely is going to be more than what you have on your tax returns. So if it doesn't fit into that, then we have what's called a DSCR, and that's for investment properties, where we use the rental income that the appraiser gives us on the rent schedule to cash flow the payment. So as long as it cash flows, then we can do the loan just based on that. We don't collect tax returns at all on these programs, right? So it's just based on these two sources of income, bank statements or the rent schedule. If going back to DSCR, if it doesn't cash flow, we still have options, right? We can do another program that allows 75% of the rental income, it still goes cash, or down to zero, right? As long as you're putting 30% down and you have certain credit score, then we can do it with a zero cash flow.
I just know that there hasn't been to date. We've been working together for a couple of years. You have not had any loan that you could not approve. I do know that. There's
Well,
always
I
another
say-
program. So,
We
and
can't approve you, no one else will. And it's a big statement, I know, but I see it's happening over and over again. So,
Yeah, so one program that I do want to mention is the last stage, right? Well, there's two more, I'm sorry. So there's a profit and loss program, which means your CPA or licensed tax preparer will give us the profit and loss for your business. We'll use that to base your income off. No bank statements.
self-employed people.
Got to be self-employed. Yeah, we do have a bank statement product for somebody that's not self-employed, but this P&L program requires you to be self-employed. And the last one is no income verification at all. So minimum credit score is 700. You got to put at least 25% down, but you don't even need to have a job for this. As long as you meet those two requirements and you have reserves in the bank, they'll give you the loan.
Okay, and the other thing I wanted to ask is closing costs. I find that not everyone realizes that in addition to the down payment, when you buy a house, you also have to come to the closing table with closing costs. And I have not bought a house outside of Florida in a very long time, so I don't know what closing costs are in another state, but I know that here they're pretty expensive when you're financing. How much in general are closing costs in addition to the down payment
well, I'll say it's between 3 to 5%.
of the purchase price?
Of
So
the purchase price.
if you're buying, I know that it depends on what kind of loan you have, but if you're buying a $500,000 house, it's 15 to 20.
At least 15 to 20, 25. It really depends. So, for example, if the borrower decided to lower the interest rate by paying a point or two, it can go even higher, right? So
Okay.
1 point equals 1% from a loan amount, right? So if the loan amount is $500,000, so it's additional $5,000 for 1 point. It really depends on the situation, or the program, and everything, and or the client needs as well. So I'll say it's minimum 3%, which is really low on the low side, right? To 5%. So when we talk to the borrowers, we usually do recommend to have at least extra 5% to make sure that they're not going to be at the end of the when they go under contract, they're not going to be like short of funds. Yeah.
If someone doesn't have that, are you able to roll that into the loan? Closing costs or no?
I mean, they can't roll, like, it's difficult with this rates to you roll entire closing costs, right?
Mm-hmm.
But it's like a math. There's so much calculation. It's
case by case, right?
Yeah.
But I mean, we do have 100% financing programs available. So in that case, let's say you had a borrower, they have 3% to put down, right? Well, that 3% would then get applied towards the closing costs instead of the down payment, because they're doing 100% financing. So a lot of people ask that question, right? Can I roll this money into the loan? Technically, you can't roll it into the loan, but I can give you a higher loan amount, and then you're just paying the closing costs, right?
But that's kind of like seller concession, where you offer them a little bit of a higher price and ask them to give some money back at closing to help with the closing costs. I guess I just answered my own question.
Yeah, and we could do that as well, right? So we could offer 100% financing, and then we could get the seller concession to pay the closing costs, so that our borrower is only really having to come up with maybe an appraisal fee.
Yes.
And sometimes, depending on the deal and how much the concession is from the seller, they might not even have to pay that.
Okay, and one last question I had. How are you guys seeing the changes with the commission structure in the real estate industry? How is that affecting realtors? Are you seeing, a lot of buyers asking for seller concession to help pay for the commissions?
So with this change to the real estate industry, to the commission to the buyer, mortgage industry adjusted a little bit as well. So now addition to the limits of regular limits for seller concession on the programs, for example, for conventional minimum down payment, it used to be like a limit 3% seller concession, right? So now mortgage industry added 3% more, or there's actually no limit, right? Additional that
Wow.
seller can pay toward, as a seller concession towards real estate agent commission. So those limits still stay the same, except we added extra concession that can go towards buyer's agent commission, which really is pretty much the same thing as was happening before, right?
A lot of people don't understand that buyers always paid the commission. It
Yes,
just, yeah.
exactly. It's kind of the same thing. They just kind of switched a different way. So now it's just the real estate agents are, writing in offers with extra 2, 3, whatever percent commission, seller concession towards their commission. So, and I've seen it's been pretty successful lately. Right. I mean, there's still some little bit of adjustment going, and some agents and buyers a little confused. But I think it's settling in little by little, because everyone realizes this is the same thing. It was always the same thing, right? It was always seller never didn't have to pay seller buyer agent commission. It was not like he was not obligated to do it. He did it for a reason, right? So, the reason so that he can actually sell a property and buyers come to the open house or just see the property. They added same thing, just you look at it a different way.
I understand it, but a lot of people don't, because they're always thinking, well, it doesn't cost anything for the buyer, but really you are paying that commission, because when you offer 800,000, the seller gives back 3% automatically. They just renamed it to seller concessions these days.
Same thing, just different name.
Okay. And are you guys busy in Florida with applications? Has it slowed down, between, let's say, because I know interest rates started going up first quarter of 2022, because I remember we were looking into buying a house then, and that's when the interest rates started to go up. Are you seeing a lot of, still a lot of activity in Florida?
I mean, I think right now, it was a little bit slower to Florida, because the market, summer is not the Florida market, right?
Yeah, but we saw, a lot more activity, I'd say, over the last 30 days, because we did have a little bit of a dip in the rates, and that little dip in the rates brought, a flood of buyers that may not have qualified, right? They say that for every 1% an interest rate that drops, that's another 5 to 10 million buyers that you have back in the market. So it makes a big difference. And I think as the rates continue to come down, that market, along with season, is going to, push the market back up in Florida. So we've definitely seen a lot more activity over the last 30 days.
More activity, yeah. And it's kind of I hope 2020, 2021 not going to repeat itself, because it was crazy, right? There's just bidding wars,
I hope it repeats itself.
I don't know. I hope it will be a little bit in the middle.
I don't think we'll ever see those.
It was fun. I won't lie, it was fun, but now we are paying for it, because there's a lot of things that happen where people bought too high. A lot of things happen, and it's the repercussions are not that great, but it was fun. I won't lie.
That's the real estate market, right? It always goes up and down, but for the most part, it keeps going up, right? It's a great investment.
You're very right. All right, guys. Well, listen, this is super informative. Thank you. And I'll link your information for anyone that's looking to buy a home. And thank you. We were working on a Sunday.
Thank you so much.
All right. Nice seeing you, Alina. Good talking to you. Hope to see you soon.
Good to see you.
All right. Bye.